There is very frequently a backwardation between London and COMEX. Now, what that tells us is that the shortage really is in London, the shortage of physical stuff. But equally, if you look at COMEX, the swaps are short. Of that, there is absolutely no doubt. And I think that, if you look at the position overall, I think the establishment is short of silver across both markets.
Look, I think gold is going higher. I think this goes to the same logic as before. Debt, other issues, inflation will keep the metals going higher. I mean, gold pushed back again over 5,000 today before pulling back. I would expect gold, and I would hope that gold would consolidate somewhere between 4,000 and 5,000 and then make its next move to the upside. I think we're in the beginning of a brand new bull market here, and a much bigger bull market that could extend, and I could see gold getting to 6,000 rather quickly. I could see silver getting back to that 120 level. Again, it's not going to be tomorrow, but I could certainly see these events occurring, and it wouldn't surprise me if they came in the front half of the year here.
The precious metals market is currently flashing a critical warning signal: frequent backwardation between London and COMEX, which points to an acute shortage of physical metal in London. While paper markets continue to fluctuate, the underlying data reveals that swaps on the COMEX are heavily short, suggesting the financial establishment is caught offside across both exchanges. This structural disconnect implies that the physical scarcity is becoming severe enough to override paper price suppression mechanisms, potentially forcing a massive cover of short positions. Alasdair Macleod, head of research at Goldmoney, and Todd Bubba Horwitz, chief market strategist at BubbaTrading.com, analyze this developing liquidity crisis. Looking ahead, the market appears to be entering a brand new bull market driven by systemic debt and persistent inflation. Gold is expected to consolidate between $4,000 and $5,000 before launching a move toward $6,000, while silver is projected to reclaim $120. Analysts suggest these milestones could materialize within the front half of the year, marking a significant departure from previous trading ranges. Now, we present the clips from Alasdair Macleod and Todd Bubba Horwitz's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
I haven't actually done the calculations because you've got two markets. So we're only seeing half the story. I think it's true to say that in the case of gold, the short positions on COMEX are actually covered by long positions in London. And they're probably net long. I mean, if you bear in mind that at the last LBMA conference, which was where I think it was in South Korea just a few months back, the consensus forecast was around about $5,000 an ounce. And at the time, gold was around about, I think, sort of four or something like that. So, they were seeing higher prices. Now, I'm cynical enough to believe that, if you're actually short in both markets, you're not going to produce a forecast, if you like, at a conference saying it's going up. No, you're going to produce a forecast saying it's going nowhere or it's going down. So I think it's true to say that the establishment, if you like, as a whole in gold is net long. But of course, they're net long in synthetic gold, not the real stuff. So that is a potential problem as these markets become increasingly destabilized. The case in silver, I think, is somewhat different. I'm sure that there are some long positions in silver, synthetic again, forward positions. But if you look at COMEX, I mean, that I think is really where the problem is. No, sorry, let me just go back on that one. There is very frequently a backwardation between London and COMEX. Now, what that tells us is that the shortage really is in London, the shortage of physical stuff. But equally, if you look at COMEX, the swaps are short. Of that, there is absolutely no doubt. And I think that, if you look at the position overall, I think the establishment is short of silver across both markets. How much is very, very difficult to say. But what we're seeing in effect with people standing for delivery is they're converting synthetic silver into real silver. And that is the problem the establishment has. And there is an additional problem, and that is that because there is so little speculative interest in silver, you can't really shake the trees and get some stock back, if you like, or close off some of your paper liability. And that, I think, is the nub of the problem. But the whole thing is being led by the nose upwards by Asian demand, particularly in Shanghai, but also, dealers in places like Singapore are finding they're still queuing around the block to take delivery of physical silver coin and small bars. You've got effectively two approaches. The one you've described as a trading approach. Okay, this is not something to trade. What we're seeing is the end of the fiat dollar-based currency system. And what that means is that unless someone actually steps in and recognizes this and does something about it, the purchasing power of the dollar is going to zero. And on recent indications, that's going to happen really more quickly than perhaps we originally thought. So on that basis, you've got to understand that if you're looking at buying gold or silver, it's not them going up so much, though obviously with the volatility, silver is actually recovering quite quickly, as is copper, incidentally. But it's more a question of the dollar going down. So when it comes to hoarding, if you like, taking a position, getting out of credit, you have to ask yourself not the question, is gold going down? No, you have to ask yourself, will the currency stop going down? That's the question you need to ask yourself. And I'm sure that, there will be, nothing happens in a straight, smooth line, but basically the loss of purchasing power of the dollar measured by gold, which remember is real legal money, despite what the Treasury has been telling us over the last 55 years, measured in real legal money, the decline in the dollar is accelerating, and it's accelerating really quite alarming. What I sort of suggested in a recent article is that because they have got an exchange control regime, effectively splitting off the domestic market from the international market, they could actually go back onto a silver stamp for the domestic yuan and effectively peg the rate between silver and gold. So we could be going back to the days when you've got, let's say, a sort of 15-to-1 gold-silver ratio, but it will be run very, very tightly by China. It could get away with it because it has ring-fenced its domestic market through exchange control. So I think that's an interesting thought. I think that's the way they would go. Now, what they started off actually in 1983, as long ago as that, by deciding that they needed to accumulate gold and silver. They started accumulating gold in 1983. This was the People's Bank of China who were appointed for this specific role. At that time, no Chinese citizen was allowed to possess gold. I haven't actually looked into the silver bit, but I think certainly as far as gold was concerned, that was the case. And so between 1983 and 2002, the Chinese ramped up their gold mine production, they ramped up their refining capacity, and they were buying gold in international markets in a bear market. And they were doing this so skillfully that nobody really noticed it. I mean, there was a missing bit, if you like, in this whole story with Frank Veneroso, who was looking at gold leasing. This was the original carry trade, whereby, you could lease gold, say, for 1%, less than 1%, sell it into the market and invest the proceeds into US treasuries. And in theory, go back and buy the gold in the market when the lease expired. Now, some of those leases may indeed have worked that way, but it does appear that an awful lot of gold which was leased into the market was sold into the market, never ever to return. And I think Frank Veneroso reckoned that it was adorning the necks of Asian women. I have a different story. It was actually being picked up by the People's Bank of China, very, very quietly.
The precious metals market is currently defined by a severe structural disconnect between synthetic paper derivatives and physical reality. While institutional forecasts remain bullish, predicting $5,000 gold, the actual plumbing of the market reveals deep vulnerabilities, specifically backwardation between the London and COMEX markets. This signal points to an acute shortage of physical metal in London, leaving the establishment effectively short of real silver, even if it holds paper longs. As investors increasingly stand for delivery to convert paper promises into tangible assets, the limited speculative inventory makes it nearly impossible for bullion banks to cover their liabilities without triggering a price explosion. On a macro level, this volatility marks the terminal phase of the fiat dollar system, where purchasing power is accelerating toward zero against real legal money. The decline is not just a trading fluctuation, but a fundamental collapse of the currency itself. Meanwhile, China has been quietly preparing for this shift since 1983, methodically accumulating vast reserves of gold and silver while the West sold off its holdings. Analysts suggest that Beijing's strict exchange controls could allow it to eventually implement a domestic silver standard, potentially pegging the yuan to metals and reverting to a historical gold-silver ratio, effectively insulating its economy. Let's get back to the interview.
Well, I think that the sell-off in silver, especially, which was down 36% Friday, was pretty predictable. I mean, I'm not going to say 36% was predictable, but the inevitable crash or fall, when you get a market that goes parabolically higher and they just keep buying, what happens when the market finally reaches the peak, there's no buyers left and there's nobody to sell to. And I think that a lot of people found out during this period that had silver that were trying to sell maybe some of their physical metals, that there was no bid on the street either. It was very hard to get anywhere near a spot if you were a seller. So at the end of the day, the markets fell apart. And of course, when the selling begins, the margin calls come in and the selling accelerates. Now we have found, we've traded as low as about 70. Well, right now, exactly at this moment, we're trading at 83.12. I would expect to be in consolidation. I think the healthiest part for silver here, if it would trade sideways for a while and build a new higher base and then make another run. I think we're going to make higher highs this year. But again, you cannot have everybody on one side of the market. It's like sitting on a teeter-totter. You get everybody on one side, you can't go back up. And I think that's what we saw and that's what we witnessed. And again, I'm still bullish silver, but I could certainly understand the big pullback. And of course, sell-offs like rallies are typically over-exaggerated. Markets are never different. Okay, I mean, I think we've seen a dramatic change from the 08 and the earlier moves that went from $5 to 50 and then crashed. Okay, this, I believe, is a better market. There's a lot of reasoning. There's a lot of fundamental news behind why the metals are going higher. The massive amount of debt that you are seeing in the government. That is a pure read to have metals go higher. The inflation is still high, no matter what they tell you. The numbers are BS. Inflation is still too high, and with the Fed, that is a totally worthless organization, they continue to think about cutting rates. Now, if you look at the rate cuts, now they didn't cut last meeting, but they cut last year 3 times, and of course, the interest rate to the public went up from 3.99 to 4.5. So an interest rate cut does not benefit the consumer necessarily. It benefits the banks and their borrowing rate from the Federal Reserve, allowing them to make more profit. So all of those reasons suggest that the metals are going to go higher. And you still have central banks buying, you have governments buying metals, because again, I think they really see the potential of the fiat currency collapse. Because each time the fiat currency rallies up and down, each consumer loses value and buying power. And I think that's what will keep metals higher. Now again, there's going to be a pullback. We just saw one. And if we went back to 60, I wouldn't go be crazy, but we're not going back to 5, in my opinion. We're not going back to 20. I think we broke out of that long extended range, or we're between, let's say 15 and 30 for years. And I think now we're going to settle up and find a new base, a new level. But it's got to do with the overwhelming amount of debt that this country is in. Well, it's pretty volatile. It's just obviously when you're dealing with a $5,000 asset class versus 100, But listen, gold dropped 12%. I mean, it was pretty fast, pretty vicious, right? I mean, down 500 one day, down 600. Look, I think gold is going higher. I think this goes to the same logic as before. Debt, other issues, inflation will keep the metals going higher. I mean, gold pushed back again over 5,000 a day before pulling back. I would expect gold, and I would hope that gold would consolidate somewhere between 4,000 and 5,000 and then make its next move to the upside. I think we're in the beginning of a brand new bull market here, and a much bigger bull market that could extend, and I could see gold getting to 6,000 rather quickly. I could see silver getting back to that 120 level. Again, it's not going to be tomorrow, but I could certainly see these events occurring. And it wouldn't surprise me if they came in the front half of the year here.
Looking ahead, gold is expected to consolidate between $4,000 and $5,000 before launching a rapid move toward $6,000. Similarly, silver is projected to recover and reclaim the $120 level, potentially achieving these milestones within the first half of the year. This outlook frames the current price action not as a bear market, but as the turbulent beginning of a much larger extended bull run that has finally broken free from multi-year trading ranges. The driving force behind this resurgence is the accelerating erosion of fiat currency. As government debt spirals and inflation remains structurally high, the wealth stored in paper currency is quietly confiscated. This reality ensures that demand for tangible assets will persist, serving as the ultimate protection against a financial system in which the currency itself is the failing asset. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.